Thank you very much. Senator Klobuchar.
Thank you very much, Madam Chair. Thank you for joining us, Chairman. As has been explained by my colleagues, at its peak, FTX was revealed to have been a shell game in which the company gambled with customer money through its hedge fund. The $8 billion hole in FTX's balance sheet not only raises questions about regulatory oversight and transparency, but also about market structure and how centralized and interconnected much of the digital asset market is. So I'm going to start with something that kind of leads off of what Senator Stabenow was asking about. When retail investors purchase traditional financial assets like stocks through cash markets, the transaction is typically carried out through several different entities, including a broker, an exchange, and a clearing and settlement company. FTX, like many other digital asset companies, consolidated several of these processes under one roof. To what extent did centralization and vertical integration of FTX play into its ability to conceal operational risk and fraud from regulators, auditors, and investors? Would rules about conflicts of interest requiring transparency and disclosure make a difference to manage risks in the future? So maybe answer the centralization question and then how you fix it.
Yeah, Senator, this question about vertical integration is a key question. It's one that we were dealing with the application that FTX had before us. In many respects, it's, and I said this earlier in my opening statement, we have to be mindful of this structure because the FTX application was not the first to the CFTC, and it's not going to be the last. So it's a very important issue that we need to think about. The Financial Stability Oversight Council mentioned vertical integration as a risk or potential risk. And, on one hand, it is a product of technology and the ability to have direct execution to a trading platform or a clearinghouse. And there may be merit there, but as you point out rightfully, there's a lot of potential risks. And that ability to consolidate control over multiple parts of a trade execution or a trade as sort of evolution. So it may have made it easier for FTX. I don't know exactly because really this goes to the point of a lack of regulation and a lack of insight into FTX and what was happening within the entity and whether or not anyone was identifying these issues. Obviously, conflicts of interest, which you've identified, is a serious issue.
So something that clearly contributed to the collapse is the fact that the exchange took customer funds that it was supposed to safeguard and then lent it to its sister company, Alameda Research, that made reckless gambles, it appears, with that money. My colleagues already asked about the requirement to register. What should be done? Could you talk about what you think the role of the SEC should be in this, and balancing with what role you should be in a perfect world? How do you think this would work? Because we clearly are living in an imperfect world when you look at the collapse that we just saw.
Well, I think the responsibilities would largely be the same, but they would be drawn on the line of what is a security token and what is a commodity token. Much of the market structure that both the SEC and the CFTC implement is similar in terms of overseeing trading platforms, the exchanges, the clearinghouses, and the broker-dealers or the intermediaries. In addition, the investment advisors and the market makers, which is, as you mentioned, the Alameda Institution. If we have regulatory authority and regulatory insight into these institutions, then we can impose the requirements around conflicts of interest, about separation of customer money and house money, about disclosure requirements for investors, about books and records that regulators can frequently or even at will examine when needed, having an auditing function. These are all, again, core elements that both the CFTC and CFTC impose on our regulated entities, and I think at its fundamental foundation, nothing needs to change in terms of what we do now with what we should do for digital asset markets.
Okay. The cash market is dominated, for digital assets by retail investors who may not understand the differences in protections offered by digital asset market platforms and traditional financial service companies. Consumers have been inundated with crypto advertising. Anyone that watched the Super Bowl knows what I mean, aimed at stirring feelings of urgency, stoking fears of missing out. For the securities market, brokers must follow the SEC's best interest rule and FINRA's suitability standard, which sets rules of the road for the types of instruments brokers can recommend to clients. Do you believe there should be parallel investor protections between digital commodity companies acting as brokers and prospective investors? What additional practices should be required of digital commodity brokers?
Absolutely. In terms of disclosures to investors, the best interest rule and similar rules are absolutely needed to ensure that investors understand the risks of the underlying asset. I've said this many times about the distinguishing factors between commodities and securities and what an ongoing disclosure about the underlying asset would be. But in terms of disclosures to investors before they invest, knowing what they're investing in and how they're doing it, those types of requirements are critically important, and we're doing what we can with what we have right now to provide as much information to investors who are using our markets for Bitcoin futures and other similar products.
But you believe more must be done
100%.
as soon as possible.
Yes.
Okay, last question. In many cases, cryptocurrency companies have utilized social media platforms, including the accounts of influencers and celebrities, to create hype for digital asset products. Last month, the SEC fined Kim Kardashian $1.26 million for failing to disclose she was paid $250,000 to promote a cryptocurrency token on her Instagram account. The FTC has called the blend of social media and cryptocurrency, quote, a combustible combination for fraud, and found that, this is a quote, since the start of 2021, more than 46,000 people have reported losing over $1 billion in crypto to scams. How does the CFTC plan to work with the SEC, FTC, or any other alphabet agency to combat the growing nexus of fraud between digital commodities and social media?
Senator, we work with both agencies, all agencies actively right now. We are in close collaboration on enforcement matters. We're in close collaboration on getting advisories out and word out in terms of customer protections. This is not new or not different than what we've done historically in the swaps market or the futures market. We will continue to do that. We have a shared interest in protecting customers and filling gaps in the marketplace. And there's no doubt in my mind that Chairman Gensler and I will continue to do that to the extent that authority is provided.
Thank you very much.
Thank you.